Welcome to the summary of the 2011 Private Equity Compensation Report from privateequitycompensation.com. Now, we don't have time in this video to answer all of the questions that are answered in the full report. Compensation averages, base versus bonus payouts, which titles are earning the most and how, who shares in the carried interest and at what level, how does fund size and performance affect pay, and what's the impact of hours worked on compensation. Oftentimes we look at surveys and of course we're interested who participated, who was involved in the collection of this data. And once again this year we have a very impressive list of participating firms, and of course these are listed with permission from the respondents themselves. But the point here is that there are going to be some names that you recognize, some of the larger firms as well as some of the niche firms. To give you a sense of who was involved here and how much experience they have, you can see here that we strongly represent the mid-career stage. On average, respondents are closely evenly split between the 10-year mark in terms of work experience, and when it comes to private equity and venture capital experience, that splits closer to 5 years. So how do the firms break out in terms of the type of firm? Well, the majority are from what we refer to as a pure play private equity firm. That is, their focus is on private equity only. Then we have 18% coming from the traditional venture capital space, and then about a quarter of the respondents are in firms that do both private equity as well as venture capital. When we asked the question about the size of the most recent fund that was raised, about a quarter had less than $100 million funds, about another quarter had more than $500 million, and about half the respondents represented $100 to $500 million funds. And one thing that we've learned over the years is size does matter when it comes to private equity compensation, and this will give you a sense of the difference between the firm size as well as the group size. And there are some, about almost 20%, about 18% or so, that are in firms that have 100 or more employees. However, the vast majority are working in groups that are less than 10 employees, and even the majority, over 60%, are working in firms with less than 10 employees. And this is really the makeup of the private equity and venture capital industries. Last year we reported that 1 in 3 saw no change in compensation over the previous year. This year that ratio is much higher. In fact, almost 1 in 2 reported no change in their compensation. And this actually turns out to be a good thing for those who are reporting, because that shift came primarily from the number of people who felt their compensation would actually decrease. As 2010 wraps up, 45% expect double-digit increases over last year. The average expected increase was about 13% in total. In a year where buyout deals heated up and the big players were complaining about being priced out of the market for some deals, private equity professionals reported a solid increase in total earnings over the previous year, with the average cash earnings coming in at $230,000. When we take a look at the makeup of that compensation, as we see every year, the more money you make, the more you rely on your bonus. So at the lower levels, the bonus plays a much smaller percentage of total compensation. Once you start getting above the $500,000 mark, then we're really seeing about a 50-50 break between base and bonus. So how did the funds perform in 2010? Well, last year, about half the firms reported positive fund performance. This year, that number is an impressive 85%. And of course, we would expect that to show in bonuses as well. And that's exactly what they told us. Last year, there was plenty of discussion around the bank bailouts, the public scrutiny of the financial pay programs, especially the bonuses. This year, funds performed well, and you can see that the average expected bonus increase went right along with fund performance. So one of the hot topics, of course, in the compensation arena is guaranteed bonuses. The vast majority of respondents told us they do not have any sort of guaranteed bonus. That is 72%. 28% of the contributors told us they did have some level of bonus, although the level of guarantee was all across the board, from 5% all the way up to 100%. Clearly, there was no standard for this. Employees representing firms with funds larger than $500 million, they earned 44% more on average than smaller firms. With regard to bonus, the average expected bonus for 2010 is 21%. And the largest increase in bonus came from those firms with funds of over 500 million. And how did they pay out between the different types of firms? Well, there are some notable differences. Common titles such as associate, director, managing director, and principal show very different levels of compensation based on the firm type. There are significant differences in total comp across these firms. Now, continuing the trend from last year, for most positions, the VC firms don't keep up with the pure play private equity funds when it comes to compensation. And what does a typical private equity work week look like? Well, 70% reported working between 50 and 70 hours per week. 20% work more than 70 hours a week, and only 8% work between 40 and 50 hours a week. Now, relative to, for instance, investment banking, a fairly tame work schedule. So how does the length of work week reflect in one's total compensation numbers? Well, we can see here that after somebody breaks the 70-hour per week mark, things start to decline, with the exception of those that are working more than 90 hours per week. Now, in the final report, we also took a look at pay per hour, which is always an interesting number. And of course, the correlation is a little bit different from that perspective. And how concerned are people these days about their job security? We've seen significant changes in this over the last couple of years. So 41% are somewhat concerned, 48% not concerned at all, and 11% very concerned. Those who are concerned about job security primarily commented on fundraising ability and market conditions. Interestingly, on the other side of the coin, market conditions also played a big part in why people are not concerned, because they feel like the market's picked up and they've got more job options. When it comes to striking a balance between work and personal life, 40% told us that they are striking an above average balance. Another area that we look at in terms of work environment is we ask about the quality of the training program available at the firm. And frankly, the firms failed this test terribly. You can see from the graph here that almost 40% say that their training is absolutely non-existent, nearly 20% say it's weak, and you've got about 25% saying that it's average, and very few respondents told us that their training was excellent. So this is actually an opportunity for those firms that are really looking to win the long-term talent war. Now, perhaps the hottest topic in private equity compensation is that of carried interest. Given that profits are required in order to realize upside, levels of carry still have not returned to 2007 levels. Now, for those with carry, they report having a holding period just shy of 3.3 years to be fully vested in their carried interest. We also asked people what was their portion of the carry pool. You can see that 44% said they had no carry whatsoever, 25% said they had less than 5% carry, 9% said they had 25% or more, and then it was really across the board between those two levels. We also asked people about satisfaction, and this year 36% reported being happy with their compensation. Last year, that number was 40%. Now, this is 2 years in a row that compensation satisfaction has decreased, and that's a sure sign that the private equity job market is heating up again. So who's happiest with their compensation? Well, you can see from this graph, sorted by seniority, who's happiest with their comp. And an interesting thing here is back in 2007, only 26% stated they were happy with their comp. And at that point, the industry was realizing big profits, and professionals were hearing whisper numbers about greener pastures from their industry contacts. You see, happiness is a relative state, and a downturn market can produce contentment via dampened expectations, but the opposite is also true. Now, we've just scratched the surface here, and as you can see, here is a graphic that shows all of the figures that are included in the full report. And you can see there's over 40 different charts and graphs that detail out compensation benchmarks for the private equity industry. We invite you to visit privateequitycompensation.com. There you can download a sample of the report as well as buy the full report.